Okay, let's imagine something for a second. You've heard about a company that's, innovating, making waves, but their stock isn't trading on any public exchange.
Right.
Yet, they're raising money, bringing in investors to fuel their growth. How do they even do that without the massive public spectacle of an IPO?
Yeah.
And maybe more importantly, how might you, as an investor, potentially get a piece of that action before it hits, like the public market frenzy?
That scenario you're picturing, that whole world of private capital raising, here in the U.S., it's largely navigated through something called a private placement.
Okay.
And for many companies, the key to unlocking that is a set of rules from the SEC known as Regulation D.
Regulation D, Reg D. So this deep dive is all about understanding how companies can essentially, bypass the traditional, really heavy-duty process of registering their securities with regulators. By using these private placement methods, specifically under Regulation D.
Exactly. We're going to zoom in on what that means for companies looking to raise funds and, crucially, what it means for you if you're considering investing in these non-public opportunities.
Right.
We'll unpack the rules, especially those under Rule 506, look at who can invest, how companies find them, and maybe most importantly, shine a bright light on the risks involved and how you can protect yourself.
Okay, so our mission today then is to cut through the complexity of U.S. private placements under Regulation D, particularly Rule 506's different pathways, 506B and 506C.
That's the plan.
We want to pull out the essential insights from the material we have, giving you a really clear, practical understanding, sort of shortcut to being well-informed on this often opaque corner of the financial world. Let's dive in.
Sounds good. So to set the stage, what exactly is a private placement in this context?
Good question.
It's fundamentally a securities offering think stocks, bonds, other stuff that isn't required to be registered with federal or state regulators. The company, the issuer, is selling these securities directly to investors, but they're doing it outside of that full public registration process.
So why would a company choose this over, say, going public with an IPO down the line? What's the appeal?
Well, it generally boils down to efficiency. Compared to a registered offering, an IPO, private placements are typically easier, quicker, and less expensive for the issuer.
Easier, quicker, cheaper. That sounds like a winning combo.
It is. They avoid the huge amount of paperwork, the massive legal fees, and just the sheer time involved in preparing a public registration statement and going through the whole SEC review process.
That speed and cost saving must be incredibly attractive, especially for younger companies, right?
Absolutely. And this is exactly where Regulation D comes in.
Okay, connect the dots for us.
So Regulation D, or Red D, as everyone calls it, is the set of rules the SEC created to provide specific exemptions from the registration requirements of the big law, the Securities Act of 1933.
Right, the 33 Act.
That act basically says if you offer or sell securities, you generally have to register them unless you meet an exemption. Red D provides several pathways to qualify for such an exemption.
Making it easier to raise money privately.
Exactly. It makes capital formation much more accessible for companies, particularly smaller ones, by simplifying these private offerings.
And the sources we looked at really highlight Rule 506 within Reg D as being like the main engine here, providing something called a safe harbor. What does that safe harbor actually do? What does it mean?
Okay, think of Section 4A2 of the Securities Act as the general exemption for transactions by an issuer that don't involve a public offering. It's broad, but it's also a bit, uncertain.
Okay, a bit vague maybe.
Yeah, exactly. Rule 506 is like a specific, clearly marked path within that general area. By complying with all the specific requirements laid out in Rule 506, a company's offering is automatically deemed non-public by the SEC. It's a specific safe harbor from those registration requirements. It gives the issuer legal certainty that they qualify for the exemption. It's easily the most frequently used exemption for private capital raises in the U.S.
Got it. Follow the specific steps in Rule 506, and you're legally considered a private offering, not a public one needing full registration. Now, before we get into the two main flavors of Rule 506, are there foundational requirements that apply no matter which route a company takes, like baseline rules?
Yes, definitely. There are several critical requirements applicable to any offering conducted under Rule 506, whether it's 506B or 506C. A big one is the filing of Form D.
The notice filing. I've heard of that.
Exactly. The company must file a notice with the SEC on this Form D. Now, it's not something they have to do before they start the offering, but rather within 15 days of the first sale of securities.
Okay, after the first check clears, basically.
Pretty much. It's essentially telling the SEC, hey, Just so you know, we're doing a Reg D offering, and the sources point out that Rule 507 is the enforcement hook here. It penalizes issuers who fail to file this required Form D. They could lose the ability to use the exemption later.
Okay, so get that Form D within 15 days of the first sale. Crucial. What about the securities themselves that are being sold? What's special about them?
This is absolutely critical for any potential investor to grasp. Securities sold under Rule 506 are considered restricted securities.
Restricted? What does that mean in plain English?
It means you can't just turn around and sell them tomorrow on the New York Stock Exchange like you would shares of Apple or Google. They generally cannot be resold without either being registered themselves, which is super unlikely for an individual investor, or qualifying for a separate exemption from registration, like Rule 144 after a holding period.
Yeah, they're not freely tradable. You can't just cash out easily.
Not at all. The sources really stress that this makes the investment illiquid.
Illiquid. Okay.
Illiquid means there are limited or maybe no readily available opportunities to sell these securities quickly or easily. You might end up holding onto the investment for a very long time, potentially years, maybe even decades, waiting for what's called a liquidity event.
Like the company getting bought or finally going public.
Exactly, an acquisition or an IPO. But until then, you could genuinely get stuck if you need access to that capital sooner. This lack of liquidity is one of the fundamental risks that differentiates private placements from public market investments.
Illiquidity. That's a really important word to understand here. Less paperwork for the company often means less flexibility, less liquidity for the investor. What other general requirements are there?
A very significant investor protection piece is the bad actor disqualification rule.
Bad actor. Sounds serious.
It is. This rule makes a company ineligible to rely on Rule 506 if the company itself or certain key people associated with the offering, think officers, directors, managing members, certain promoters have specific disqualifying events in their recent history.
Like what kind of events?
Things like certain criminal convictions, SEC disciplinary orders, court injunctions related to securities laws, or other legal findings related to securities fraud or misconduct.
Okay.
The NASA source, which represents state securities regulators, specifically highlights this as a major warning sign of potential fraud. So investors should absolutely try to verify the backgrounds of the people running the show.
That makes perfect sense. If the people involved have a history of getting in trouble with the law or regulators, especially securities regulators, that's a huge red flag.
Huge, absolutely. Then there are also rules around integration. This gets a bit technical for the issuers, but it's important conceptually.
Okay.
It's about preventing a company from doing, say, multiple, small, supposedly separate private offerings that, when you look at them together, really function like a single public offering that should have been registered.
Trying to sneak around the rules by breaking it up.
Kind of. The SEC has rules to analyze whether separate offerings need to be integrated or treated as one single offering. This can affect how a company structures multiple fundraising rounds close together.
Okay. Avoiding the backdoor public offering trick. Got it. And state laws. You mentioned federal registration exemption. Are state rules completely bypassed by Reg D?
Not entirely. Rule 506 offerings are exempt from state registration requirements. This is due to federal preemption under a law called the National Securities Markets Improvement Act, or NSMIA.
So the states can't make you register the offering?
Correct. However, this federal exemption doesn't mean states are completely out of the picture. Issuers are typically still required to comply with state notice filing requirements and pay associated fees in the states where they actually sell securities to residents.
So it's like a heads up to the state, not a full approval process.
Exactly. It's a notification, often involving filing a copy of the Form D and paying a fee, but it's a compliance step that absolutely can't be ignored. You have to check the rules in each state where you have investors.
Got it. Federal registration exemption, but state notice filings likely still apply. Okay, so we've covered the general ground rules. Form D, restricted securities meaning illiquidity, bad actor checks, integration, state notices. Now, you mentioned Rule 506 has two main branches, 506B and 506C. How do they differ? This sounds like a key decision point.
It's a fundamental strategic choice for the company, absolutely. Rule 506 is indeed divided into these two subcategories, 506B and 506C. They present two distinct pathways for the offering, and the choice dramatically impacts everything: how you find investors who can invest, the compliance steps required, everything.
Let's start with 506B. This is often described as the sort of traditional private placement route, right? the old school way.
That's a good way to put it, yes. The defining characteristic of Rule 506B is a strict prohibition on general solicitation and general advertising.
Okay, no advertising. What does that prohibition actually mean in practice? Like, what can't they do?
It means the company cannot go out and broadly market the offering to the general public. They can't run ads in newspapers or magazines. They can't put up a banner ad on a public website saying, invest in us. They can't do mass mailings or email blasts to lists of potential investors they don't already know.
No TV commercials for their private stock offering.
Definitely not. No public seminars discussing the investment opportunity. No posts on social media asking broadly for investors. It has to be kept, well, private.
So no public appeals for cash. How on earth do they find investors then if they can't advertise?
They have to rely on pre-existing relationships. The source material emphasizes this heavily. Investors must be people the company or its agents already have a substantive pre-existing relationship with.
Substantive pre-existing relationship, what does that actually mean?
It means a relationship formed before the offering started, where the company or its agent has enough information about the potential investor's financial circumstances and sophistication to know that the investment might be suitable for them. It can't be a relationship formed through the general solicitation itself.
So you can't just meet someone at a conference and pitch them immediately.
Generally not, unless maybe that conference was specifically for pre-screened investors or something. It usually means reaching out to people they already know well or people they find through trusted private networks. Think introductions from existing investors, connections through venture capital firms or angel groups they have relationships with, private meetings, invite-only events. It's all about targeted outreach within a known circle.
Okay, so the company has to tap into its existing network. Who is actually allowed to invest in a 506B offering then?
This rule offers some flexibility on the investor side, which is interesting. A company using 506B can accept investments from an unlimited number of accredited investors.
Unlimited accredited.
And we'll definitely dive deep into that accredited investor definition in a bit, as it's absolutely key to this whole area. But significantly, under 506B, they can also include up to 35 non-accredited investors in the offering.
Wait, 35 non-accredited investors are allowed in 506B? Yeah, that sounds like a really critical difference compared to what I think 506C allows.
It is. It's a major distinction. So what are the requirements for the company regarding these different investor types in a 506B?
Yeah, how does it work?
Well, for the accredited investors in a 506B deal, the process is relatively straightforward for the issuer, the company. The investor can typically just self-certify their accredited status.
Like checking a box on a form.
Pretty much. They check a box on the subscription agreement or a separate questionnaire saying, yes, I meet the criteria, and they sign it. The issuer can generally rely on this representation unless they have specific knowledge or reason to believe it's false. There isn't a strict verification requirement imposed by the rule on the issuer for these accredited investors in a 506B.
Okay, so less administrative burden on the company for the accredited folks under 506B. But what about those non-accredited investors? Those up to 35 slots, that sounds trickier.
Ah, yes. That's where the burden increases significantly for the issuer under 506B. If non-accredited investors are included, the company must make a subjective determination for each one of them.
Determination about what?
They need to have a reasonable belief that each non-accredited investor, either on their own or together with a designated purchaser representative like an advisor, has sufficient knowledge and experience in financial and business matters to be capable of evaluating the merits and risks of the investment.
So it's a sophistication test. Not about their money, but about their financial savvy.
Exactly. It's not about their net worth or income, though they still need to be able to bear the economic risk, but about their financial literacy and their ability to understand what they're getting into, the risks involved.
Wow, so the company has to effectively assess the financial sophistication of any non-accredited investor they bring in. That sounds like a potentially difficult and maybe risky compliance step for the company.
It absolutely is. It's subjective, it requires documentation, and it carries compliance risk. It's a key reason why many issuers, even when using 506B, choose to limit their offerings only to accredited investors. Even though the rule technically allows those 35 non-accredited slots, it just simplifies things.
Makes sense. And does including non-accredited investors trigger anything else, like more paperwork?
Yes. big time. It also triggers much more extensive disclosure requirements.
More disclosure. I thought the point of private placements was less disclosure than an IPO.
Generally, yes, but if you include non-accredited investors in a 506B offering, the rules require the company to provide them with disclosure information that is substantially similar in terms of the type of information to what would be required in a registered public offering.
Seriously. Like a mini prospectus.
Pretty much. It means providing detailed financial statements, although the source notes, they don't necessarily have to be audited depending on the offering size and issuer type. A thorough description of the business, its management, the use of proceeds, the terms of the offering, and very importantly, significant risk factors.
Oh, wow.
The sources point out that preparing this level of disclosure significantly increases the preparation time and costs for the company. It starts to look a lot more like preparing for a public offering.
Okay, but what if the 506B offering is only to accredited investors? Do they still need all that disclosure?
No, that's the key distinction. If the 506B offering involves only accredited investors, these extensive specified disclosure requirements under the rule itself are generally not mandated.
Oh.
However, and this is crucial, the general anti-fraud provisions of the securities laws always apply. Rule 10b-5, for example. This means the company can never make materially false or misleading statements or omit material facts necessary to make their statements not misleading, regardless of who the investors are or which exemption they're using. So they still need to provide enough accurate information for investors to make an informed decision, even if the specific format isn't dictated by the rule for accredited-only deals.
Got it. Anti-fraud always applies. So including non-accredited investors in 506B adds both the sophistication test and the heavy disclosure requirements. That paints a pretty clear picture of 506B. What are the main advantages, then, for a company choosing this traditional path?
The advantages are really tied to that network-based, quieter approach. One big one is the potential for better, deeper investor relations.
How so?
By relying on existing relationships and trusted networks, companies can often build stronger connections with a potentially smaller, more engaged group of investors. These might be individuals or firms that truly understand the business, the industry, the team. They can become valuable long-term partners offering insights, advice, and connections that go way beyond just the capital they provide.
Right. More than just passive money. They can become strategic allies, part of the team almost.
Exactly. Another advantage is lower regulatory visibility, generally speaking. Since there's no general solicitation, the offering is much less public. It typically attracts less attention from regulators compared to a widely advertised 506C offering. This might mean fewer questions or compliance reviews down the line.
Flying under the radar a bit more.
To some extent, and there's a definite privacy benefit, too.
Yeah, you mentioned that. How important is that?
It can be very important, as the sources note, especially for companies working on disruptive technologies or unique business models. Keeping their fundraising efforts private can be a significant strategic advantage. It prevents competitors from knowing exactly how much they're raising, who their backers are, or maybe even what specific milestones they're funding. Raising money quietly through a private network offers a level of discretion that a public solicitation doesn't.
Okay, so lower profile, potentially deeper investor relationships, and strategic privacy. Those are solid reasons for choosing 506B. What are the limitations or the downsides?
Well, the biggest limitation, which the sources really emphasize, is that dependence on your existing network.
Right, you said success hinges on that.
It really does. Success under 506B relies heavily on the strength, the quality, and the reach of the issuer's existing relationships and network. If a founder is new to the industry or maybe operating outside of major investment hubs like Silicon Valley or New York, building that robust investable network can be a huge challenge.
So your fundraising potential is basically capped by your connections, who you know.
To a large extent, yes. It limits your potential pool of investors to essentially who you know or who your immediate network knows. It can be harder to reach new pockets of capital.
That seems like a real constraint. What else?
Another challenge is the constant risk of inadvertently blowing the exemption through general solicitation. Companies have to be extremely careful in all their communications about fundraising.
How so?
Even casual mentions of fundraising at, say, a public industry conference or maybe a vague post on social media, if it's interpreted by the SEC as a broad appeal for investment rather than just factual business information, could be deemed non-compliant general solicitation. That could potentially jeopardize the entire offering's exempt status. It requires real vigilance.
Wow, you have to be constantly watching what you say publicly, even indirectly.
Absolutely. The boundaries can sometimes feel blurry, and it usually requires careful legal guidance to navigate. Finally, as we touched on before, including those non-accredited investors in a 506B round, while allowed, really does add complexity.
The sophistication check and the disclosures.
Exactly. It increases the issuer's burden significantly, and it can also potentially complicate future fundraising rounds. If the next round is, say, a 506C, which only allows accredited investors, or if the company is thinking about an IPO down the line, having those non-accredited investors on the cap table from an earlier round can sometimes create issues that need to be addressed.
Okay, so 506B, keep it quiet, rely on your network. You can include up to 35 non-accredited folks.
Yeah.
But it comes with extra work and disclosure and potentially lower regulatory scrutiny overall. Now, let's flip the coin. Rule 506C. This sounds like it really changes the game.
It absolutely does. Rule 506C was a major innovation that came out of the JOBS Act, the Jumpstart Our Business Startups Act, which Congress passed back in 2012. Its core characteristic, the thing that makes it totally different, is that it allows general solicitation and advertising.
Whoa. Okay, you mean companies using 506C can actually market their private offering publicly, like run ads?
Yes. That's the game changer. A company using 506C can advertise its offering broadly. They can use pretty much any public channel, online ads, social media campaigns, email marketing to purchase lists, radio spots, TV, print articles, public demo days, cold calling, seminars open to the public, all the things that are strictly forbidden under 506B.
Wow. That opens up the potential audience massively, doesn't it?
Hugely. It allows companies to reach way beyond their immediate network and potentially connect with interested investors anywhere.
That sounds incredibly powerful for finding capital.
Yeah.
So what's the catch? There has to be a catch, right? If they can advertise publicly, who are they allowed to actually sell the securities to?
Here's the big trade-off. While general solicitation is allowed, the investor pool under 506C is restricted exclusively to accredited investors.
Ah, okay. Only accredited investors. No non-accredited allowed at all.
Zero. Rule 506C strictly prohibits the inclusion of any non-accredited investors. Every single person or entity investing in a 506C offering must be accredited. That's the price for being allowed to advertise publicly.
Okay, so public reach, but only for accredited investors. That makes sense as a balance. Now, how does the company know these investors are accredited? Do the investors just self-certify like they can in 506B? Check the box.
No, and this is the other major critical difference, and frankly, where the compliance burden really shifts heavily onto the issuer in 506C. The issuer must take reasonable steps to verify that every single investor in the offering is, in fact, an accredited investor.
Verify, not just rely on their word.
Correct. They can't just rely on a check mark on a form. They have to actively take steps to confirm the investor's status. The sources emphasize again and again that the burden of proof for this verification rests squarely on the issuer. Thorough documentation of the verification process is absolutely crucial for compliance. If the SEC comes knocking, the company has to show how they verified each investor.
Reasonable steps to verify. That phrase sounds really important. What does the SEC consider reasonable? What are some ways companies actually do this verification?
The SEC provides some non-exclusive examples, sort of safe harbor methods that are considered reasonable ways to verify under 506C. The sources detail these pretty clearly. One common method is income verification.
Okay, how does that work?
The issuer can review an investor's internal revenue service forms, like tax returns, W-2s, or K-1s for the 2 most recently completed years. The investor needs to show they met the income threshold, remember, over $200,000 individually or $300,000 jointly in both of those past 2 years. Plus, the investor has to provide a written statement that they have a reasonable expectation of reaching that same income level in the current year.
So looking directly at official income documents from the past, plus a statement about the present. Okay, what about verifying net worth? If someone qualifies based on the $1 million threshold.
For net worth verification, the issuer can examine various financial documents, things like bank statements, brokerage account statements, certificates of deposit, tax assessments, or appraisal reports for assets. They can also look at a consumer credit report from one of the major reporting agencies to check liabilities.
And these documents need to be recent.
Yes. Generally, they should be dated within the preceding 3 months. The investor needs to provide evidence that their total assets exceed their total liabilities by at least $1 million, explicitly excluding the value of their primary residence, consistent with the definition. And again, the investor typically provides a written representation that all the information provided is true and complete.
Okay, income check or net worth check using recent documents. Is there another common way, like involving professionals?
Yes, there's a very practical third-party verification method. The issuer can obtain a written confirmation from certain qualified independent third parties stating that they have taken reasonable steps to verify the investor's accredited status within the prior 3 months.
Who counts as a qualified third party?
The rule lists registered broker-dealers, SEC-registered investment advisors, licensed attorneys in good standing, or certified public accountants, CPAs, who are duly registered and in good standing. Getting a confirmation letter from one of these professionals who has already done the verification work is a very common and often efficient approach, especially for investors who work regularly with these types of advisors.
Right, leverage the work someone else qualified has already done. So these are concrete, documented ways a company must verify accredited status under 506C. It's definitely way more involved than just taking someone's word for it, like in 506B.
Much more involved, and the record keeping is key.
What about disclosure requirements for 506C offerings? Since it's only accredited investors, is it less demanding than the 506B scenario with non-accredited folks?
Generally, yes, because 506C offerings are limited only to accredited investors who, remember, are legally presumed to be more sophisticated and able to assess risk. The specific mandated disclosure requirements under the rule itself are more flexible. They aren't required to provide that mini prospectus level of information that's triggered by non-accredited investors in 506B.
So potentially less paperwork again.
Potentially. Now, remember, the anti-fraud rules always apply. You still can't lie or omit material facts. The company still needs to provide investors with sufficient information to make an informed investment decision. But the format and the specific content dictated by the rule are less rigid. The offering documents, like the Private Placement Memorandum, PPM if they use one, can often be more streamlined compared to the public-style disclosures required for non-accredited investors in 506B.
Okay.
The sources suggest this streamlined disclosure process can potentially reduce legal and administrative costs for the company, which is another plus for 506C.
Okay, let's recap 506C then. Public advertising is allowed, but investors must all be accredited, and the company must take reasonable steps to verify that status, with more flexible disclosure rules but the ever-present anti-fraud standard. What are the big advantages of taking this route? Why go through the verification hassle?
Well, that ability to generally solicit opens up some really significant doors, especially in today's connected world. The sources talk about the potential to access a truly global investor pool.
Global? How so?
With the rise of online investment platforms, digital marketing, and virtual communication, 506C allows companies to effectively market their offering far beyond their immediate geographic location or personal network. They can potentially reach accredited investors anywhere in the world who might be interested in their specific industry or stage. This can lead to more diverse funding sources, maybe different perspectives, and potentially more competitive terms or even higher valuations because you're reaching a wider market.
A truly digital, potentially global fundraising capability. That sounds powerful.
It is. It also allows for better integration with emerging financial technologies, or fintech.
Like what?
Because you can solicit publicly online, companies can leverage sophisticated online investment platforms that handle parts of the process. They might use blockchain technology for things like cap table management to enhance transparency and efficiency, or maybe utilize AI-driven tools for better investor matching, identifying potentially interested accredited investors based on data analytics, and managing outreach campaigns. 506C fits much more naturally with modern digital marketing and financial infrastructure.
Connecting fundraising directly to fintech innovations. That makes sense. Any other big advantages?
One more the sources mentioned is a potential synergy with the evolving secondary markets for private company stock.
The ability to maybe sell those illiquid shares later.
Potentially. As platforms emerge trying to create more liquidity for private securities before an IPO or acquisition, having conducted a 506C offering, which involves a documented base of verified accredited investors, might provide a better foundation for accessing those secondary liquidity options down the line. It demonstrates a certain level of process and an investor base that might be more suitable or comfortable with trading on these emerging secondary platforms, making the initial investment potentially more attractive to those seeking earlier exit strategies.
Interesting. So 506C could lay the groundwork for future liquidity options. Okay, those are some compelling advantages.
Yeah.
Global reach, digital integration, potential future liquidity. What are the limitations or the challenges of using 506C? It can't all be easy.
Definitely not. The sources highlight several significant challenges. A huge one is cybersecurity and data privacy.
Because they're collecting sensitive financial info for verification.
Exactly. Since you're soliciting publicly and, more importantly, collecting highly sensitive personal and financial information from potential investors to perform that required verification tax returns, bank statements, etc., startups need to invest heavily in robust cybersecurity systems and protocols to protect that data.
Yeah, a data breach would be disastrous.
Catastrophic, especially with increasingly stringent global data privacy regulations like GDPR in Europe or CCPA in California. Managing and securing all that personal financial data safely and compliantly is a massive undertaking and a significant liability risk.
That sounds expensive and requires real expertise. What else?
Another challenge is just staying on top of the evolving regulatory landscape. As we've touched on, the rules around private placements, accredited investors, and online solicitation are constantly being reviewed and sometimes updated by the SEC and state regulators, partly in response to technological changes and market developments.
So the rules might change under your feet.
They can. Companies using 506C, especially those leveraging online platforms, need to be agile. They need to continuously monitor SEC guidance, interpretations, and any rule changes and adapt their compliance processes accordingly. This requires ongoing resources, legal expertise, and management attention. It's not a set-it-and-forget-it compliance environment.
Constant vigilance on the regulatory front, too. And because the offering is more public, does that invite more scrutiny on the company itself, maybe its valuation?
Yes, that's another potential challenge the sources mention: valuation scrutiny. When you solicit publicly, even just to accredited investors, your company's story and, critically, its valuation are open to a much wider discussion and comparison.
More eyeballs looking at your numbers.
Exactly. Early-stage companies, in particular, often have limited operating history and financial track records. They need to be prepared to rigorously justify their valuation with solid data, believable metrics, and realistic financial projections to a potentially skeptical broader audience than they might encounter in a more closed, private, network-based 506B round. Getting the valuation wrong, or not being able to defend it well publicly, can hurt the round's success.
Okay, so 506C offers that incredible reach in digital integration, but it demands significant investment in verification infrastructure and cybersecurity, constant regulatory awareness, and the ability to confidently defend your company's valuation in a more public forum. That gives us a really clear contrast between the two paths, 506B and 506C. How should a company actually decide which path is right for them? It sounds like a complex choice.
It's definitely not a simple decision, and there's no single right answer. It really depends heavily on the unique circumstances, the stage of the company, its specific goals for that particular fundraising round, and even the dynamics of the market at that time.
What are the primary factors they should weigh when making that call between 506B and 506C?
The sources point to several key considerations that usually drive the decision. First and foremost, who is the target investor audience?
Okay, who are they trying to raise money from?
Exactly. If the company absolutely needs or really wants to include some non-accredited investors, maybe key early employees who've been granted options but don't meet the financial thresholds, or perhaps close friends and family who believe in the company but aren't accredited, then 506B is really the only option on the table because 506C strictly forbids non-accredited investors.
So that's a clear dividing line right there.
It is. Conversely, if the target pool is primarily sophisticated investors like high net worth individuals, institutions, venture capital funds, or family offices who are almost certainly already accredited, then 506C becomes a viable and potentially very attractive path because of its reach.
Okay, so step one, know your desired investors. What's next?
Second, think about their advertising needs and overall fundraising strategy. Do they need to actively market the offering beyond their immediate network to reach their fundraising goal? Do they want to leverage online platforms? If yes, then 506C provides that necessary allowance for general solicitation.
But if their network is strong enough?
Right. If their existing network of contacts and prior investors is robust enough to likely fill the round, and they prefer a more discreet, controlled process, then 506B fits that strategy much better.
Compliance capacity seems like a huge factor too, especially with that verification burden in 506C.
Absolutely critical. The issuer needs to honestly assess their internal capabilities. Do they have the team, the systems, the budget, or their ability to hire external vendors and legal counsel to handle the rigorous investor verification required under 506C, plus the ongoing cybersecurity needs we discussed.
And if they don't have those resources?
If those resources are limited or the cost seems prohibitive, then 506B might present fewer administrative hurdles and lower upfront compliance costs, especially if they decide to limit that 506B offering only to accredited investors who can self-certify.
Makes sense. And what about their fundraising goals in terms of speed and amount?
Yes, consider the amount of capital needed and the desired timeline. 506C's broader reach could potentially accelerate the fundraising process by bringing in more potential leads faster. However, it also might require more upfront work to develop marketing materials suitable for public consumption and set up those compliance and verification systems before launching.
Whereas 506B?
506B might be slower if the network outreach takes time, but it could potentially be faster to initiate if the compliance setup is simpler. Again, especially if limited to accredited investors, and they can tap into existing warm relationships quickly. So there's a trade-off there too.
And thinking long-term, does the choice affect future rounds?
Crucially, yes. The sources note that the choice made for one round can impact future fundraising rounds. While it's technically possible to switch exemptions, maybe do a 506B seed round and then a 506C Series A, it requires careful planning and legal counsel to ensure compliance, especially around integration rules and managing different investor types or rights. So the initial choice should ideally consider the company's overall longer-term capital raising strategy.
That's a really helpful framework for understanding the company's perspective in choosing between 506B and 506C. Now, stepping back for a moment, we've been talking almost entirely about private placements as an alternative to, say, an IPO. Let's just briefly place these two main options side by side for context.
Right. Good idea. When a private company decides it needs significant capital and wants to get it by issuing securities, stock, or debt, the two main avenues typically considered are a private placement, like the Reg D ones we've been dissecting, or going public through an initial public offering, an IPO. They're fundamentally very different beasts.
An IPO is the big one, right? The one everyone hears about on the news, ringing the bell at the stock exchange.
Exactly. An IPO is when a company sells its securities to the general public for the very first time. It's usually a massive undertaking, often managed and underwritten by major investment banks. The key result is that the company's securities become available for anyone to buy and sell relatively easily on a public stock exchange, like the NYSE or NASDAQ. That creates the public secondary market.
And the regulatory burden that comes with an IPO is immense, right? Lots of hoops to jump through.
Absolutely immense. IPOs require a very detailed and costly registration process with the SEC, involving a comprehensive disclosure document called a prospectus. And perhaps more importantly, once public, the company is subject to continuous, rigorous public financial reporting requirements, quarterly and annual reports, disclosures of material events, strict accounting standards like Sarbanes-Oxley. It's a very transparent but also very demanding way to operate.
And the sources mention that even with all that required disclosure in the prospectus, IPOs can still be risky for investors.
Yes, because even though there's a lot of information, there's no prior public trading history for the stock to help evaluate its price or volatility. The prospectus is crucial, but it contains forward-looking statements and risks. Investors really need to read that prospectus carefully and understand the business before jumping in.
Didn't the JOBS Act try to make IPOs a bit less daunting, especially for smaller companies?
Yes, that's true. The JOBS Act, the same law that brought us Rule 506C, also included provisions aimed at making the IPO process slightly less burdensome for companies designated as emerging growth companies. EGCs. It streamlined some of the historical financial statement requirements and executive compensation disclosures, for example, hoping to encourage more smaller companies to consider going public.
Okay, so that's the full public route IPO. High visibility, high regulation, public trading. How does the private placement really stack up against that?
As we've explored in detail, a private placement involves selling securities directly, but not to the general public. The sale is targeted to a select group of investors, primarily accredited investors, which can include sophisticated individuals, but also often involves institutions like venture capital funds, private equity firms, investment banks, pension funds, and mutual funds buying for their own accounts.
And usually for smaller amounts than a huge IPO.
Typically, yes. Companies using private placements are often seeking smaller amounts of capital than would justify a major IPO, and they're selling to a limited, often pre-identified or targeted group of investors rather than the entire public market.
And the key difference, again, is that registration exemption under Reg D.
Precisely. That's the core benefit. Offerings conducted properly under Regulation D, like Rule 506B or 506C, are exempt from those intense SEC registration requirements, and crucially, they allow the company to avoid becoming subject to the ongoing burdensome public reporting requirements that follow an IPO.
So it saves the company considerable time and money and allows them to raise capital while remaining privately held, avoiding that constant public scrutiny and the cost of continuous reporting.
Exactly. Quicker, cheaper, and you get to stay private.
Sounds like a good deal. Are there downsides compared to an IPO besides maybe raising less money?
Well, the main trade-off, besides potentially accessing less capital than a blockbuster IPO, is liquidity. As we discussed, the securities sold are restricted and illiquid. An IPO creates immediate liquidity for selling shareholders and the company's stock. Also, the sources note that marketing a private placement can sometimes be harder in certain ways because the investment is inherently riskier, less information, less liquidity, and only available to a limited pool of investors. But for a company that values its private status, wants to move faster, and doesn't need or want the scale and burden of the public markets yet, private placements are an absolutely essential tool.
Okay, that comparison really helps frame where these Reg D private placements fit into the broader capital raising landscape. Now, let's circle back hard to that term we keep using because it's so central, accredited investor. It's clearly the linchpin, especially for 506C, and often the target for 506B too. Let's really nail down what it means for an individual to qualify.
Absolutely. Understanding the accredited investor definition is crucial for anyone wanting to participate in these private markets, either as an investor or for companies raising funds. It's a specific legal standard defined by the SEC, primarily in Rule 501 of Regulation D. It essentially acts as the gatekeeper, deciding who is eligible to participate in most Reg D offerings, certainly all 506C deals, and often the vast majority of investors in 506B deals by issuer choice.
So what are the most common ways an individual gets through that gate? The financial tests.
Yes, the traditional ways are based on financial thresholds. The sources detail these clearly. The first one is based on net worth. An individual must have a net worth of at least $1 million.
$1 million.
Yes, and this can be calculated either alone or together with a spouse or spousal equivalent. But, and this is a key point often misunderstood, the calculation must explicitly exclude the value of their primary residence.
So you don't count your main house equity towards the million.
Correct. It's $1 million in assets outside of your home equity. So investments, savings, maybe a vacation home minus liabilities other than the mortgage on your primary residence, up to its fair market value.
Okay, $1 million net worth, excluding the primary residence. Got it. What's the other main financial test? Income.
Yes, the other common way is based on income. An individual must have earned an annual income of over $200,000 for each of the 2 most recently completed years.
$200K for the last 2 years.
Yes. Or, if calculating jointly with a spouse or spousal equivalent, a combined income of over $300,000 for each of their same 2 most recent years.
$300K joint income for the last 2 years.
Right. And there's one more crucial part to the income test. In addition to meeting the threshold for the past 2 years, the investor must also have a reasonable expectation of reaching that same income level in the current year.
Okay, so $200K individual or $300K joint income for 2 years running and reasonably expecting to hit it again this year. Those are the traditional financial hoops. But you mentioned earlier the definition has expanded beyond just money, right? Based on knowledge or expertise.
Yes, that's a relatively recent and very significant development. A few years ago, the SEC modernized the definition to include individuals based not just on their wealth, but also on certain measures of professional knowledge, experience, or certifications.
What kind of certifications or knowledge qualifies?
The rules now specifically include individuals holding certain professional certifications and licenses in good standing. The main examples given are individuals holding a Series 7 General Securities Representative, Series 65 Investment Advisor Representative, or Series 82 Private Securities Offerings Representative license.
So certain financial professional licenses count.
Yes. Also included are knowledgeable employees of private funds investing in that fund. And the SEC added specific designations like registered architects and certified public accountants, CPAs, in good standing. The idea is that individuals with these proven levels of financial sophistication or relevant professional expertise should be considered capable of assessing these investments, even if they don't meet the high income or net worth thresholds.
That's a really interesting shift, recognizing expertise alongside wealth. It potentially broadens the pool quite a bit.
It does, and there's been talk about potentially expanding it even further, hasn't there?
Yes, The sources note that back in December 2019, the SEC actually proposed further amendments to the definition that could have significantly broadened its scope even more, potentially adding more categories of individuals based on other qualifications or allowing investors to qualify based on their investments in certain types of private funds.
But that proposal hasn't gone through yet.
Correct. That specific 2019 proposal hasn't been finalized or acted upon yet by the SEC. So while it shows that the definition is clearly an area of ongoing regulatory focus and might change more in the future, for now, the current rules are the $1 net worth, excluding home, the $200K, $300K income test, or those specific professional licenses designations and knowledgeable employee status.
Okay, so those are the current gates. And the underlying logic, the reason these thresholds exist, is that the SEC presumes if you meet these criteria, you're financially sophisticated enough to handle the unique risks of private placements without needing the full safety net of public registration and disclosure.
Exactly. The legal premise, fair or not, is that accredited investors are presumed capable of assessing the risks and merits of these complex, often illiquid, and less transparent investments. They're expected to be able to conduct their own due diligence and essentially fend for themselves financially if the investment goes sour. They don't require the same level of detailed, mandated regulatory protection as the general public investing in registered offerings.
Fend for themselves. That phrase really highlights the increased risk, doesn't it? Which brings us squarely to the darker side of this world. With less regulatory oversight before the offering, and often less required disclosure, it definitely sounds like private placements could be ripe for potential problems, maybe even outright fraud.
That is absolutely correct, and it's arguably one of the most important warnings for anyone even thinking about investing in this space. The sources we reviewed, particularly from the SEC and state regulators like NASA, are very, very blunt about this.
Blunt.
They state clearly, private placements are inherently risky, they are illiquid, they are speculative, and there's a significant potential to lose your entire investment value.
Wow. Entire investment. And the risk of fraud is actually higher than with public companies.
Significantly higher, according to the regulators. There are several reasons. Issuers in private placements often have limited operating histories, maybe modest revenues, sometimes no revenues at all. They aren't required to provide the same depth, quality, or frequency of information as public companies.
And the big one.
And the big one we keep coming back to. These offerings are not reviewed or approved by regulators like the SEC or FINRA before they are offered for sale. There's no regulatory stamp of approval on the deal itself.
So regulators usually only find out about problems after the fact.
Exactly. Regulators often only discover fraud or serious issues after investors start complaining, by which time the investor's money may already be gone, spent, or hidden offshore. State securities regulators, in particular, report frequently bringing enforcement actions against fraudulent private placement schemes, but often it's too late to recover much for the victims.
So the message is crystal clear. You are largely on your own to vet the deal thoroughly before you invest because the regulators haven't done it for you.
Precisely. Caveat emptor, let the buyer beware, applies perhaps more strongly here than in almost any other area of investing.
Okay, so what are the specific red flags? What should investors be actively watching out for, according to the SEC and NASA sources, to avoid getting caught in a bad deal or a scam?
The sources provide a really critical list of warning signs, almost a fraud checklist. First, and it bears repeating, fully understand that there is no prior regulatory review. Don't ever assume that just because an offering is being made, or even because a Form D has been filed, that any government body has vetted the company, the promoters, the business plan, or the risks. They haven't.
That's the crucial baseline understanding. Got it. What about the promised returns? That always seems like a potential hook for scams.
Huge red flag area. Be extremely skeptical, immediately suspicious of any promises of high returns with little or no risk.
Why?
Because it fundamentally contradicts the nature of these investments. Private placements must offer the potential for high returns precisely because they are inherently much riskier and less liquid than traditional investments like publicly traded stocks or bonds. If someone is touting guaranteed high returns or saying there's basically no downside risk, they're either lying or don't understand the investment themselves. High potential reward in this space always comes with high risk. Claims of low risk with high returns are almost certainly fraudulent.
Okay, guaranteed high returns, run away. What about the illiquidity we talked about? How is that a red flag?
It's not just a feature. It's a risk factor that needs to be fully accepted. Understand up front, before you invest a dime, that you are likely committing your capital for a long, potentially undefined period. You will likely have very limited, if any, Options to sell your shares if you need access to your funds unexpectedly. If the salesperson downplays the illiquidity or suggests there are easy ways to get out early, that's a red flag. If you're not genuinely comfortable with potentially locking up that money for 5, 7, 10 years or even longer, this type of investment is probably not suitable for you, regardless of the potential upside.
So be realistic about being locked in. What about the information or lack thereof provided by the company?
Expect less information and potentially lower quality information than you'd get from a public company. EUers aren't required to provide the same rigorous audited financials under GAAP in many cases. They might use unaudited statements or projections. The main disclosure document you typically receive is called a Private Placement Memorandum, or PPM.
And the red flag related to the PPM.
The sources emphasize that you must read the PPM cover to cover, very carefully. Understand the risks that are described if they are described adequately. But critically, you cannot just rely on the PPM. You need to do your own independent due diligence to verify key claims, research the market, check out the management team, and assess the overall reliability of what's being presented. A PPM that is poorly drafted, full of jargon, vague, or seems incomplete is itself a major red flag. Don't invest based on a sloppy or confusing document.
So the PPM is essential reading, but it's the starting point for your own investigation, not the end point.
Got it. What about how you hear about the deal, especially under 506C, where they can advertise anywhere?
Right. Even though general solicitation is allowed under 506C through ads, social media, seminars, etc., the sources warn that you, the investor, still bear the full responsibility for doing your own due diligence on the information being disseminated in those ads. Don't assume it's true just because it's advertised.
Be wary of the sales pitch. Absolutely. Be particularly wary of high-pressure sales tactics. And specifically, the sources say unsolicited offers, cold calls, spam emails, random social media messages, especially those that push secrecy, don't tell anyone else about this amazing deal, or urge you to act fast before it's gone, are highly suspicious and very often indicative of fraud. If you encounter information in a public solicitation that seems false, misleading, or overly hyped, the sources advise notifying securities regulators.
Okay, secrecy, urgency, high pressure, all bad signs. What about the people involved? We mentioned the bad actor disqualification rule. That seems like a critical check.
Absolutely reiterate that one. The presence of bad actors is a critical red flag. Before investing, try to find out who the key principals, officers, directors, and promoters are. If any of them have a history of securities fraud, relevant criminal convictions, or significant disciplinary actions from regulators like the SEC or state agencies, that should trigger extreme caution. The NASA source highlights this as a primary indicator of potential fraud. Use available resources online like regulator databases or even simple web searches to check the backgrounds of the people involved.
So check out the management team's history. What if the company or salesperson doesn't seem to care much about your qualifications, like whether you're actually accredited?
That is a definite, clear-cut danger sign, except for very limited exceptions, like the 35 non-accredited slots in 506B, which require sophistication checks. Federal and state securities laws require investors in most of these private offerings to meet those strict income or net worth requirements for accredited status.
So if they don't ask?
If the company or the person selling the investment doesn't ask you detailed questions about your financial situation, doesn't require you to fill out a comprehensive accredited investor questionnaire, or, especially in a 506C offering, doesn't take steps to verify your status, that is a massive red flag that the offering may be non-compliant or potentially an outright scam. They should be asking for this information. Expect to provide it. If they gloss over it, keep your money.
Okay, so if they aren't asking you about your money and status, you should definitely hold on to your money. Good rule. What about the structure of the entity or the fund itself? Any red flags there?
Yes, the sources caution against situations where the manager or promoter seems to be the only party involved in the operation. Particularly in a fund context like a private equity or venture capital fund, you should expect to see credible, independent third-party service providers listed in the offering documents.
Like who?
Like a reputable law firm that drafted the documents, an independent auditor for the financials, even if it's not required by rule, it's good practice, and maybe a third-party fund administrator that handles things like investor reporting and cash movements. These parties provide important checks and balances. If it looks like it's just one person or a tiny team operating out of a simple setup with no independent oversight, be much more wary and definitely verify that any listed service providers are genuinely engaged and reputable.
Okay, look for independent service providers. Speaking of simple setups, are there red flags related to the company's physical location or office?
Yes, this was an interesting one. Be suspicious of sham or virtual offices. Sometimes promoters will use a mail drop address or a virtual office service in a particular state, maybe to try and claim eligibility for a local exemption or just to appear more established than they are when they actually have no real operations there.
So check if the address seems legitimate for the business.
Right. Be wary if a mailing address is in a state where the company seems to have no legitimate connection or operations, especially if they're claiming some benefit from being located there. Try to verify that the company has a real operating presence consistent with their business description.
Good tip. And verifying the backgrounds of the people involved. You mentioned regulatory history, but what about just their general biography and experience claims?
Absolutely crucial. Be wary of suspicious or unverifiable biographies in the offering materials or on the company website. Promoters in fraudulent schemes sometimes exaggerate or completely invent credentials, past successes, or affiliations.
So Google them.
Yes. Use online resources, LinkedIn, news archives, and tools like Finella Ray's Broker Check, if the person selling is also a registered broker, to research the backgrounds of the key managers and promoters. If you find details that contradict what's in the offering materials or what the promoter told you directly, that's another major red flag. Don't take biographies at face value.
Verify, verify, verify. Finally, what about promises that just sound too good to be true? Or specific statements about the future that seem overly optimistic?
The sources warn strongly against misleading statements, referencing specific rules like FANARA Rule 2210 that governs communications with the public by brokerage firms, though the principles apply broadly. Be extremely wary of things like...
Like what? Give us examples.
Okay, promissory statements about a guaranteed future IPO or acquisition by a specific date. Claims about the certain success of a completely new or untried business model. Inaccurate or downplayed statements about the level of risk involved or claiming regulatory approval that doesn't exist. And especially specific predictions or projections of investment performance presented as factual or guaranteed.
So no crystal balls allowed.
Pretty much. These types of statements are often forbidden because they are inherently speculative, potentially deceptive, and designed to lure investors without a fair presentation of the risks. They are major warning signs of a potentially fraudulent or overly hyped offering.
Wow. That's a really comprehensive list of red flags. It absolutely drives home the point that in this private placement world, personal due diligence isn't just recommended, it's paramount, because those standard regulatory safety nets just aren't there up front.
Exactly.
So let's pivot to the positive. What's the investor's action checklist? How do you actually protect yourself when you're looking seriously at a private placement opportunity? What concrete steps should you take?
The sources provide very clear, actionable steps for investors to take to protect themselves. First, and perhaps most fundamentally, carefully review all the documents. Don't just skim them. Read the private placement memorandum, if provided, the subscription agreement that you're contracted by the securities, the operating agreement or partnership agreement is applicable, and especially the accredited investor questionnaire. Understand everything you are signing and agreeing to.
Don't just sign on the dotted line.
Absolutely not. And crucially, do not let the salesperson or anyone else fill out or check boxes for you regarding your financial status or sophistication without you carefully reviewing it and confirming its accuracy. Those are your representations, and you are legally responsible for their truthfulness. Make sure they are correct.
So own your information, read the fine print. Got it. What else is non-negotiable?
Related to that, a hard and fast rule. Don't fudge your numbers. Never, ever falsify or overstate your income or net worth to meet the accredited investor thresholds if you don't actually qualify.
What if someone suggests you do that?
If someone involved in the offering, the promoter, the salesperson, asks you or encourages you to misrepresent your financial situation, the sources say emphatically, walk away immediately. That is a giant red flag indicating an illegal or fraudulent offering. And then they advise you to notify a securities regulator, like your state regulator or the SEC, about that promoter's conduct.
Wow. Okay, walk away and report them. That's a clear line.
And specifically related to 506c offerings, if the issuer isn't taking those required reasonable steps to verify your accredited status, if they just take your word for it or seem uninterested in documentation, the advice is clear. Do not invest. Hold on to your money. They aren't following the rules.
Okay, don't misrepresent yourself and make sure they follow the verification rules if it's 506c. What about asking questions? How important is that?
Absolutely vital. Ask good questions and keep asking until you get satisfactory answers. The The sources advise that if the person pitching the investment cannot clearly and satisfactorily answer your questions about the company, its business model, its financials, its management team, the risks involved, or how investors will get paid back, then the investment is probably not suitable for you.
Don't be afraid to sound ignorant.
Never. You should feel completely empowered to ask probing questions, even basic ones, and expect clear, knowledgeable, straightforward answers. If they are evasive, condescending, use confusing jargon, or simply can't explain the fundamentals in a way you understand, that's a bad sign. Walk away.
Good advice. What about getting information from the company? We said expect less, but should you still demand information?
Yes. Ask for company information. While private companies aren't required to provide the same volume of disclosure as public ones, federal and state anti-fraud laws still require them to provide investors with all material information necessary to make an informed investment decision. This includes accurate information about the business, its financial condition, the management, the risks, and the terms of the offering.
So what if they withhold information you think is important?
If you ask for specific information that you deem important to making your investment decision, maybe details about their key customer contracts, recent financial performance, or management compensation, and the company refuses to provide it or gives you the runaround, the sources strongly advise you to withhold your investment dollars. Don't invest blind just because it's a private placement. Demand the information you need to feel comfortable with the risks.
Makes sense. Don't invest if they won't give you the info you need. What about the people selling the deal?
Finally, if you're working with someone who's pitching the deal or recommending it to you, especially if they present themselves as an investment professional, a broker, or an advisor, verify their licenses and background.
How do you do that?
Use the free, easily accessible online databases provided by your state securities regulator, the SEC, to its IAPD system, or FINRA using BrokerCheck. You can quickly confirm if they are properly licensed to sell securities or provide investment advice, and crucially, you can check if they have a history of customer complaints, regulatory disciplinary actions, or other red flags in their record. It's a basic but absolutely essential background check.
Okay, that's a robust checklist for individual investors. Review docs carefully, be honest about your status, ask tough questions, demand material info, and verify the seller's credentials. It really puts the responsibility on the investor. But what about the brokerage firms themselves? If a broker from a known firm recommends a private placement to you, do they have a duty to do their own homework on the deal first?
Yes, absolutely. And this is explicitly covered in the sources, particularly referencing a key guidance document from FINRA Regulatory Notice 1022. Brokerage firms that recommend private placements to their clients have a specific regulatory obligation to conduct a reasonable inquiry, essentially, due diligence into that offering before they recommend it.
So they can't just pass along any deal that comes their way. They can't just take the company's word for how great it is.
Absolutely not. The FINRA guidance states clearly that a firm cannot rely blindly upon the issuer for information concerning the issuer. The brokerage firm is expected to review the offering documents, like the PPM, but their duty goes beyond just reading it. They are expected to independently verify, research, or analyze the material aspects of the offering.
Independently verify, like what?
It means they need to make reasonable efforts to confirm the accuracy of key claims made by the issuer about his business, financials, management, etc. They can't just substitute their own investigation with reliance on the issuer or the issuer's lawyers. They need to do some digging themselves.
That's a pretty significant duty for the brokerage firm. They have to conduct their own investigation.
They do. FINRA requires firms to have adequate supervisory systems and written procedures in place specifically for reviewing private placements. These systems should be designed to ensure the offerings are suitable for the specific customers they're recommended to, and also to ensure compliance with the anti-fraud rules and other relevant FINRA regulations.
And does this obligation apply even if the investor they're recommending it to is considered sophisticated or accredited? Does the firm still have to investigate?
Yes, and this is a really key point from the source material. Even when recommending private placements to investors who are sophisticated, experienced, or meet the accredited investor definition, brokerage firms still have that duty to conduct a reasonable investigation of the offering itself.
So they can't just say, well, this investor is accredited, they can fend for themselves.
No. Their duty to investigate the investment is separate from the investor's own presumed capabilities. The firm's recommendation implies they have a reasonable basis for believing the investment is suitable, and part of that basis comes from their own due diligence on the offering. They can't just rely on the investor's status to absolve them of their duty to investigate the deal.
That's a crucial point for accredited investors to remember. Even if a reputable firm brings you the deal, they are supposed to have done their own investigation first. That could provide an extra layer of potential comfort, assuming, of course, that the firm actually fulfills that duty diligently.
Yeah, exactly. It's another check in the system, theoretically. Now, let's say you, as the investor, are doing your personal due diligence, really digging into the company itself. It's a private company, so you probably won't have audited public financials readily available. What should you focus on? How do you evaluate the business itself?
That's a great question because it can feel overwhelming without the standard public company reports. The sources provide a very practical framework for this, outlining what one source called 7 key questions that can form a solid foundation for understanding the business before you dive deep into whatever financials are available.
Okay, 7 fundamental questions. What are they? Let's hear them.
All right, here they are.
What does the company actually do? Sounds basic, right?
Mm-hmm.
But you need a clear, concise understanding of their core business model. What product or service do they offer? What problem do they solve for customers? Can you explain it simply?
Okay, the elevator pitch test. Makes sense. Number 2.
Number 2, who are the key managers of the business? This links directly back to those red flags about bad actors and unverifiable biographies. In private companies, especially early-stage ones, the management team is often everything. You need to evaluate their relevant experience, their track record, successes and failures, their integrity, and whether they have the skills to execute the business plan.
Betting on the jockey, not just the horse. Got it. Number 3.
Number 3, what stage is the business? And is the investment being offered appropriate for that stage? Is this a brand new pre-revenue idea, seed stage? Is it a company with a product and some customers looking to scale up, Series A or B? Or is it a more mature, perhaps profitable business seeking growth capital? The risks, potential returns, and appropriate valuation and investment structure vary wildly depending on the stage. Does the deal make sense for where they are on that journey?
Context is key. Okay, number 4.
Number 4, who are the company's customers? Understanding their target market is vital. Who buys their product or service? How large is that market? How do they acquire customers and what does it cost? Are they reliant on just a few big customers? Knowing the customer base tells you a lot about the business's potential and stability.
Understand the market and the buyers. Number 5.
Number 5, how is the product or service produced or delivered? This gets into the operational side. How do they actually create what they sell? What's their manufacturing process, their technology stack, their supply chain, their service delivery model? Understanding the how helps you assess potential operational risks, scalability issues, and competitive advantages.
How the sausage is made, basically. Okay, number 6.
Number 6, how does the company make money? This sounds obvious, but you need to dig into their revenue model. What are all their sources of revenue? What's their pricing strategy? What are the key costs involved in generating that revenue? Cost of goods sold, operating expenses, understanding their unit economics and path to profitability is absolutely crucial. Is it a sustainable business model?
Follow the money. Makes sense. And the last one, number 7.
And finally, maybe the most important question for you as an investor. How will investors be paid back? Remember, these are illiquid investments. So what is the plausible exit strategy? How do you eventually get your capital back, hopefully with a significant return? Is the most likely path an acquisition by a larger company, an eventual IPO? Will the company generate enough free cash flow to pay dividends or buy back shares? Is there a plan for secondary market liquidity? Understanding the potential paths to an exit is critical for evaluating the investment's potential.
Those 7 questions seem incredibly practical. What does the company do? Who runs it? What stage are they? Who are the customers? How do they make the product? How do they make money? And how do I get paid back? It really forces you to think about the core fundamentals before getting lost in, say, complex financial projections.
Exactly. The sources present them as a way to achieve that fundamental understanding first, structuring your thinking. They guide you towards the more comprehensive financial, operational, and market analysis that's needed when you're seriously considering investing your hard-earned money in private debt, venture capital, or private equity. It's a great starting framework for your own due diligence.
Excellent framework. Okay, let's shift gears one last time to something that's always important but maybe easily overlooked in the excitement of a potential investment. Taxes. Making money from investments usually means paying Uncle Sam. What are the general tax implications for individuals investing in these private placements?
You're absolutely right. Taxes are a crucial piece of the puzzle. If you make a profit from these private investments, you generally need to expect to pay federal and state income taxes. The source material specifically mentions paying taxes to both the IRS and your relevant state revenue department.
Okay, so how is the income from these private investments typically taxed? Does it depend on the investment?
Yes, the taxation method depends heavily on the legal structure of the business you're investing in. The sources use Massachusetts examples, but the underlying principles apply more broadly across the U.S., though specific state rules vary.
What are the common structures?
A very common structure for private funds in many operating businesses is a partnership or a limited liability company, LLC, that chooses to be taxed as a partnership. For these pass-through entities, the business itself generally doesn't pay income tax at the entity level.
It passes through. To who?
It passes through to the individual investors, the partners, or LLC members. They are allocated their share of the company's income, gains, losses, deductions, and credits, usually reported to them on a Schedule K-1 form. And here's the key part. The investors are typically taxed on their share of the company's income and the year it's earned by the company, regardless of whether the company actually distributes any cash to them that year.
Wait, so you could owe taxes on income you haven't actually received in cash yet?
Yes, that's called phantom income, and it's a common feature of pass-through investing. This is where tax distributions, which we can talk about in a second, become really important.
Okay, so that's partnerships, LLCs. What if you invest in a company structured as a traditional corporation, a C Corp?
If you invest in shares of a C corporation, the tax treatment is different. The corporation itself might be subject to corporate income tax at the entity level, though state corporate taxes depend on complex nexus rules about where the company operates. Then, if the corporation distributes profits to you as a shareholder in the form of dividends, you, the investor, are taxed on those dividends personally.
So potential for double taxation there, once at the corporate level, once on the dividend.
That's the classic critique of the C Corp structure, yes,
Yeah.
though the tax rates might differ.
Okay, so the structure really matters for how income flows and is taxed.
Right.
Let's talk about those dividends from a C Corp, or maybe even distributions from an LLC that aren't just tax distributions. How are those taxed when the investor receives them?
If you receive dividends from shares you own in a private company, structured as a C Corp, that dividend income is generally subject to both federal and state income tax as part of your overall taxable income.
How are they taxed? At regular rates?
Federally, it depends. Qualified dividends, typically those from U.S. corporations or certain qualified foreign corporations, provided you meet certain holding period requirements, are taxed at the more favorable long-term capital gains rates, which vary depending on your overall income bracket. It could be 0%, 15%, or 20% federally. Non-qualified dividends are taxed at your ordinary income tax rates, which are generally higher. State taxation of dividends varies. The Massachusetts example used a flat 5% rate for this type of unearned income.
Okay, qualified dividends get burned federal rates. Now, what about the big one when you finally sell your shares, hopefully for a profit? That's capital gains tax, right?
Yes, exactly. Capital gains tax is the tax you pay on the profit.
Yeah.
You realize when you sell a capital asset like your shares in the private company for more than your basis in that asset.
What's the basis?
Your basis is typically what you originally paid for the shares, potentially adjusted upwards for things like reinvested distributions or certain costs, or downwards for return of capital distributions. Calculating basis accurately is important. The tax is only due when you sell the shares and the gain is realized. Just holding shares that have gone up in value doesn't trigger the tax yet.
Okay, and the tax rate on that capital gain depends on how long you held the investment, right? Short-term versus long-term.
That's a critical distinction for capital gains, yes. If you hold the shares for 1 year or less before selling, any profit is considered a short-term capital gain. These gains are taxed federally at your ordinary income tax rates, just like your salary or interest income. The Massachusetts example showed a general rate of 8.5% for short-term gains at the state level.
So selling quickly means potentially higher tax rates. What about holding longer?
If you hold the shares for more than 1 year before selling, the profit is considered a long-term capital gain. Federally, these long-term gains are taxed at those preferential rates, 0%, 15%, or 20%, depending on your taxable income. This is usually significantly lower than ordinary income rates for most investors. The Massachusetts example had most long-term gains taxed at 5% state level.
So the takeaway is clear. Holding a winning investment for over a year before selling can result in a substantially lower tax bill on the profits.
Absolutely. That 1 year holding period threshold is very important for tax planning around investment sales. The sources also briefly mention other potential tax strategies like using losses to offset gains, donating appreciated stock, or using tax-exempt trusts, but those are more complex planning techniques.
Okay, now you mentioned tax distributions earlier related to that phantom income from pass-through entities like LLCs or partnerships. Can you explain those?
Right. Because investors in pass-through entities might owe significant taxes on their share of the company's income, even if they don't receive enough cash distributions to cover the tax bill. The governing document like the LLC operating agreement or partnership agreement often includes a provision for mandatory tax distributions.
What do those do?
These are specific cash distributions the company is required to make to the investors, calculated based on their estimated tax liability arising from the income allocated to them by the company. The goal is to provide the investors with enough cash to pay the taxes they owe due to their investment in the company. It helps mitigate that phantom income problem and improves the investor's cash flow.
That sounds like a really important provision for investors in those types of structures.
It is. The sources strongly advise investors to carefully review the operating agreement or partnership agreement before investing to understand if and how tax distributions are calculated and mandated. The specifics can vary greatly. You might even want an attorney to review that section for you.
It really sounds like the tax side adds a whole other layer of complexity and potential pitfalls to private investing, on top of the investment risks themselves.
It absolutely does. Tax laws, both federal and state, are notoriously complex, constantly changing, and the application to specific private investment structures can be nuanced. Understanding your obligations, how different types of income and gains will be treated, how the entity structure impacts you, and what state taxes you might owe is crucial but challenging.
So, what's the bottom line recommendation for investors trying to navigate this tax complexity? Go it alone.
Definitely not recommended. The sources strongly advise consulting with a qualified tax professional, ideally an attorney or CPA who has specific experience with the tax implications of private equity, venture capital, or partnership investments.
Why a professional?
They can provide personalized advice based on your specific situation, help you understand your potential tax obligations before you invest, advise on tax-efficient structuring if possible, ensure you're filing correctly, potentially identify strategies to legally reduce your tax burden over the life of the investment, and represent you if any disputes arise with the IRS or state tax authorities. Given the complexities and potential costs of errors, professional tax guidance is invaluable in this area.
Great advice. Don't skimp on tax help when dealing with private investments. Okay, finally, let's look ahead. The world of Regulation D and private placements isn't static, right? It keeps evolving. What did the source material say about the changing landscape of Rule 506 itself? What might be coming down the pike?
That's right. The regulatory environment for private placements is definitely dynamic, not set in stone. We've already discussed one major recent evolution: the expansion of the accredited investor definition a few years back to include those with specific professional certifications or knowledge, aiming to broaden access beyond just wealth.
And that other proposal from 2019 to expand it even further is still technically out there, though not acted upon.
Correct. The SEC proposed significant further broadening back then, potentially tying accredited status to investment amounts or adding more license types, but it hasn't moved forward. So the future scope of who qualifies as accredited remains somewhat uncertain, though it's clearly an area regulators are thinking about.
Beyond the accredited investor definition, are there other potential changes brewing that could impact companies using Rule 506?
Yes, the sources mention ongoing discussions and potential future rulemaking from the SEC that could impact issuers relying on Rule 506, potentially making compliance stricter in some areas.
Like what specifically? More rules? Harsher penalties?
Both have been discussed. There's been consideration, for example, of implementing stricter filing requirements for that Form D notice we talked about earlier, maybe requiring more information on the form or making the filing deadline potentially tighter or more critical.
Okay, and penalties.
Yes. There has also been talk about potentially imposing harsher penalties for non-compliance with the Rule 506 requirements. For instance, discussions have included the possibility of temporarily banning issuers from using any Reg D exemption for a set period, say 1 year, if they are found to have violated the rules in a prior 506 offering, like failing the verification standards in 506E or engaging in general solicitation in 506B.
Wow, a 1-year ban from using Reg D entirely. That would be a pretty severe consequence for a company reliant on private capital.
It would be a very significant penalty, yes. And these potential trends increase scrutiny, potentially stricter enforcement, the existing burden of verification under 506C, might make some fund managers or general partners, particularly those considering 506c, a bit more cautious, weighing the benefits of broader outreach against the increasing compliance risks and potential penalties for getting it wrong.
So the compliance stakes seem to be potentially rising in this space.
It seems that way. As technology, like online platforms and digital marketing, makes it easier than ever to connect companies and potential investors globally, regulators are necessarily reviewing and potentially updating the rules of the road to try and maintain that balance between facilitating capital formation for businesses and ensuring adequate investor protection in these less regulated markets.
It really feels like an area that's constantly adapting to the market and technology. It'll be interesting to watch how it continues to evolve.
Absolutely. Staying informed about these regulatory developments is really essential for anyone participating actively in this market, whether as an issuer or an investor.
And I recall one of the sources mentioning a tool that issuers can use to help navigate all this compliance complexity, something like a checklist.
Yes, that's right. One source specifically highlighted the existence and value of compliance checklists designed to help issuers navigate the often complex requirements of conducting a Rule 506 offering.
What would be on such a checklist?
It would typically outline all the necessary steps in a logical order. Things like confirming eligibility for the exemption, preparing the necessary offering documents, ensuring proper Form D filing within the deadline, implementing procedures for investor qualification and verification, especially the detailed steps for 506c, adhering to solicitation rules, no general solicitation for 506b, managing it for 506c, providing required disclosures, especially if non-accredited investors are involved in 506b, handling state notice filings, and maintaining meticulous records of everything.
So basically, a roadmap to stay compliant.
Exactly. Utilizing comprehensive checklists and templates, often developed with legal counsel, can help companies streamline the complex process, ensure they don't miss critical steps, and ultimately minimize their legal and regulatory risks when raising capital under Rule 506.
So while it's definitely complex and the rules need to be followed carefully, there are resources and processes available for companies trying to do it the right way.
Absolutely. It requires diligence, attention to detail, and usually good legal advice. But the pathway for compliant private capital raising under Rule 506 is well established if you follow the rules and leverage the appropriate expertise.
We have truly done a deep dive today, haven't we? Into the intricate world of U.S. private placements under Regulation D, focusing heavily on Rule 506.
We really have. We've dissected how 506B and 506C offer those two distinct pathways for companies to raise vital capital without going through the full SEC registration process. We've highlighted the crucial differences between them regarding advertising, who can invest, and especially that rigorous verification requirement for issuers using 506C.
And we've established the absolutely central role of that accredited investor definition as the primary gatekeeper for accessing these opportunities, noting how that definition itself is evolving beyond just wealth. We also put these private placements in context, contrasting them with the much more public and burdensome process of an IPO.
And perhaps most critically, we spent significant time hammering home the warnings. The inherent risks of illiquidity and speculation that come with private placements, and the very real heightened potential for fraud due to that lack of upfront regulatory review. We've hopefully armed you, the listener, with a clear understanding of the specific red flags to watch out for everything from unrealistic promises and high-pressure tactics to issues with documentations, bad actors, and sham operations.
And most importantly, we've stressed repeatedly that because of these risks, the primary burden of due diligence falls squarely on you, the potential investor. We walked through those actionable steps you can take to protect yourself. Carefully reviewing every document, ensuring your own status is represented accurately, asking those tough probing questions and demanding answers, insisting on material information, verifying the licenses and backgrounds of sellers, and never, ever letting anyone pressure you into falsifying your financial information.
We also noted that brokerage firms recommending these deals have their own duty to investigate, which adds another potential layer of diligence, but shouldn't replace your own. It's a complex but absolutely vital part of the modern financial ecosystem, offering potential growth opportunities not found in public markets, but alongside very significant risks.
So being well-informed, truly understanding the rules of the game, knowing the warning signs, and knowing how to protect yourself through diligent, independent research, as we've aimed to help you do today based on the material we covered, is absolutely essential before you even consider putting capital into this space.
Couldn't agree more. Knowledge and diligence are your best defenses.
Absolutely. And as we wrap up this deep dive, here's something to maybe leave you thinking about, building on how quickly this landscape seems to be shifting. As technology continues to blur the lines, dissolving traditional barriers, making it increasingly easy for companies anywhere to find potential investors online, and for investors anywhere to discover private opportunities through platforms and advertising. And as regulators inevitably continue to adapt, perhaps always a step behind, how will the very concept of what constitutes a private versus a public investment continue to transform in the coming years? And perhaps more importantly for you, what new, maybe currently unforeseen, forms of due diligence and risk assessment will become paramount for investors trying to navigate this increasingly digital, interconnected, and rapidly evolving private market?
That's a fascinating and a slightly unsettling set of questions for the future of capital formation and individual investing. Where does private end and public begin in a fully digital world?
It's exactly something to ponder. We really hope this deep dive has provided you with valuable insights and a much clearer map for understanding the complex but important world of U.S. private placements under Regulation D.